There we go. Okay, let's see if it works now. There we go. Okay, let's
We're
see
all
if it
good.
works now.
You hear me, Wes? We should be good to go.
Okay, I'll go ahead and start. All right, what's going on, everybody? Happy Friday. If you haven't been here before, this is webinar time with myself, Wes Gottesman. So welcome. For those of you who don't know me, I am a private wealth manager for a major broker-dealer and a market advisor for TradeZing. So welcome. Can't believe we're already at the end of the week here and almost at the end of the year. It's crazy, went by so quickly. So the topic for today's discussion, today's webinar, is risk versus reward, which to most might be a very self-explanatory idea, something that perhaps we learned when we were young. But now I'm speaking about it in terms of your investments, which again might be self-explanatory for some, but there's more to it than just however much money you put into some sort of risky investment or a conservative investment, how much you get back. So in terms of risk, each individual is going to have a certain level of risk that they're willing to take on. $100,000 that they want to put it into something like stocks or bonds, and kind of like that. Okay. So when someone comes to me and they say, "Hey Wes, I'm very aggressive with my investment style. I want to aggressively invest." And when someone says that, by definition, aggressive, risky investing is investing 100% of the portfolio in stocks. Okay. So if you're talking to a broker about that, that's what he or she is gonna assume. If you're somebody who is more moderate, they're gonna have a portion. And let me backtrack a little bit. It doesn't have to necessarily be all individual stocks. It could be mutual funds that are invested in stocks. It could be ETFs that are invested in stocks, or it could be a mixture of all of them. So with that said, if they're a little bit more moderate, that means they're going to have a portion, most likely half of the portfolio in equities, stocks, portion in fixed income bonds. Like I said, doesn't have to be individual bonds. It could be bond funds. It could be money market funds. It could be something like that. Okay. So that's the starting point when you have a risk versus reward. So obviously, if you're a conservative investor, the amount of risk that you're taking on is much less than what it would be if you're an aggressive investor. But also the amount of reward that you're getting is going to be less as well. So with that said, there are stocks that are going to be definitely on the riskier side and ones that are going to be more on the conservative side. For example, if you go and put all of your money into Tesla, okay, don't recommend that you do that, and don't take it out of context. I don't recommend nor deny anything at all that you should be doing that with Tesla, that is. Putting all of your money in Tesla versus putting all of your money in Kimberly-Clark, for example, or Johnson & Johnson. Okay, Johnson & Johnson, Kimberly-Clark, they make household items that people are going to purchase throughout the year, regardless of how the economy is doing. Toilet paper, toothpaste, soap, whatever. Tesla is a more, I want to say, media-driven, earnings-driven stock that is going to fluctuate up and down several percentage points throughout the year. So the amount of risk that you're taking on with Tesla is going to be a lot more than what you would be with Kimberly-Clark or Johnson & Johnson, all within the equity space, the stock space, okay? However, with Tesla, you could have tremendous returns given the amount of risk that it is going to pose to your portfolio. We saw that with NVIDIA this year. NVIDIA was up several 100% since about 7 or 8 months ago. I think about 7 months ago. It was at about $150 a share, and now it's teetering around the $430 a share. So people who went all in on NVIDIA took a huge risk that potentially could have gone down, but the amount of reward that was intended or suspected or predicted was much more than the risk that they were willing to take on, just because it's a calculated risk, right? So they're heavily invested into innovative technology like AI. Okay, so that's becoming more and more popular. The reward on that was absolutely tremendous. Now for Kimberly-Clark, Johnson & Johnson, you're not going to be taking on a whole lot of risk because those are very stable stocks. And you can go on to any platform or even Google it. You don't have to be any kind of crazy analyst, right? You don't need to be a chartered financial analyst, a CFA. You don't need to be any kind of analyst. If you can determine just based on the year-to-date, month-to-date, 1 year, 3, 5, and 10 inception figures or the lines on the internet or on any of those platforms that you use, you can determine if it's a stable stock or not. Okay, so the amount of return on that is not going to be nearly as much just because they're stable. They don't fluctuate a whole lot up and down. When you combine the two together, Tesla, this is all for example, still, Tesla and the two marry them into one portfolio. Now you've got something that's a little more balanced. Okay, that's one thing. Now, if you were to take Tesla and municipal bonds all in one portfolio, the next webinar next week is all about fixed income. It'll be a very interesting one and very timely as well. But that's more of a balanced approach. You've got on the bullish side, you've got Tesla that could increase tremendously, it could decrease tremendously as well. However, you're hedging that with something that's going to be less risky, something that's going to be protecting your principal, whether it's money market or if it's fixed income, right? So your principal protected on this side, money aggressively invested on the other side, all within one portfolio, gives you a balanced approach, right? So that's also a great example. Another one is being in a totally conservative portfolio. You're not taking a whole lot of risk on. Your main objective is capital preservation, secondary maybe income, right? Because fixed income is all about capital preservation with the intention that you get your principal back at maturity, but then it's also paying you an interest rate, and that interest rate is guaranteed. So guaranteed by the full faith and credit of the issuer, that is. We'll go more into that in the next webinar, but this is just to give you some context in regards to conservative, less risky investing. Okay, so the amount of risk that you're taking on in a conservative portfolio is much less, right? Because you're investing into vehicles that are going to be protecting your principal, but your reward might be 4%, if you're lucky, 5% right now because of the high interest rates that we're seeing. On the flip side, going back to Tesla, you could be getting 17, 20% returns. So with fixed income, you're getting a much more peace of mind that your principal is protected, then also receiving a small amount of interest in the meantime as well. So that's kind of how it goes in terms of risk and reward. Now, there are other investments out there that are going to be capturing those same types of risk tolerances, but outside of individual stocks and individual bonds. Okay, so there recently, and it's when I say recently, the past couple of years. Okay, so there have been companies out there that are offering buffered ETFs. Okay, I love buffered ETFs. I think that they're excellent. In particular, and I'm not being endorsed by anybody whatsoever, I think First Trust ETFs are superior. Pacer also has excellent ETFs. And by ETFs, I mean exchange traded funds, by the way. And an exchange traded fund trades just like a stock, and you would purchase it on the same platform that you would purchase a stock with. So one, for example, that most of you have probably heard of, VOO, it's the Vanguard S&P 500 Index ETF, or SPY, which is the BlackRock Spider Shares S&P 500 ETF. So or QQQ, I'm sure you've heard of on CNBC, which off the top of my head, I don't. I think it's Invesco QQQ. Yeah. So why somebody would purchase an ETF is because they are incredibly diversified. If you are purchasing the S&P 500 ETF, you are purchasing the performance of all 500 companies within the S&P 500, right? So it can go up, it can go down, but overall, you're going to be keeping pace with the market year over year. And that's attractive. It's less risky than owning stocks individually. Let's say, you've got 5 stocks that are taking they're just completely defaulting for whatever reason. You've got 495 stocks in the portfolio that are still crushing it. So the amount of risk that you're taking on when you're investing into an ETF, not very much. Or I'm sorry, an S&P 500 ETF is not very much. Okay. So going back to buffered ETFs, what happens is with buffered ETFs is that they will say, before I go into that, they purchase options on the height of the market and then on the low of the market surrounding the S&P. So they're able to give you a cap. And by a cap, I mean, if the market's up 10, you're up 10. If the market's up 15, you're up 15. If the market's up 20, you're still up 15. Okay. On the low end, they give you a floor. Okay. If the market's down 5, you're down 5. Market's down 10, you're still only down 5. That kind of thing. So others like First Trust will say they're going to give you a 10% buffer. Okay. So if the market is down 5 percentage points, you're down nothing. If the market's down 8 percentage points, you're still down nothing. If you're down 10 percentage points, down nothing. If the market's down 11%, you're down 1% because it's the 10% buffer, right? So First Trust is eating that first 10% based on the options that they built on the downside of the S&P. So that's how they're able to accomplish that. And then they'll give you a ceiling as well. Those are very conservative investments. The amount of risk that you're taking on is taken on by the ETF company, for example, First Trust. Those are excellent. Now, there's another company called Pacer ETFs. Theirs is pretty interesting. What happens is, and I'll explain the 3 of them that we use. They have one that's directly invested in the S&P. They've got one directly invested in the NASDAQ, and then they've got one invested directly into the bond market. Off the top of my head, I don't remember which segment of the bond market. There's several. So let's say the S&P is crushing it. You're invested in the S&P. Let's say their portfolio managers think that there will be some sort of contraction in the market. They will do a tax-free exchange. So this is not a taxable event for a USD holder of the ETF. Tax-free exchange for treasuries or cash or money market with a market maker on the New York Stock Exchange. So now while the market is going to crap, you're holding cash or cash equivalents right now earning about 5%. And when the market starts to rebound, then they'll do a tax-free exchange again, get back into the market, and now you're taking advantage of the benefits of being in the stock market. They do that across the S&P. They do that across the NASDAQ as well. They also have one in the bond market. When the market's favoring bonds, they have you in bonds. When the market is favoring the stocks, they'll take you out of bonds and they will put you into cash. And again, they'll do a tax-free exchange back. So there are many different ways to mitigate your risk nowadays. They didn't have these buffered options or these tax-free exchange options years and years ago. So that's always something to think about, is there are more options out there than what are presented to you. You have to find the right people that know what is available, myself being one of those. And you know that you could always reach me on Instagram at the Gottesman. You can reach me on TradeZing at Wes. So that's pretty much the broad overview of what all can be invested in from a risk standpoint. Okay, and there are even more incredibly riskier ways to invest, such as buying call options, which we can get into in another webinar. That's a whole options can be very confusing to some people, but when explained properly and simplistically, they are easier to understand. So we can definitely do that sometime. I appreciate you all giving me the time of day here. As always, feel free to reach me on Instagram at the Wes Gottesman or on TradeZing at Wes. Feel free to ask me questions anytime. Happy to answer them. And I look forward to seeing you all on the next webinar. And also be sure to follow me on TradeZing and to check into my audio rooms that I'm going to be hosting daily at 4 p.m. Eastern Standard Time. Thanks so much. Bye-bye.